Hello, friends. Welcome to the Weekend Investing Daily Bite of Friday, 28th March, last session of the month, last session of the year, um, and a decent month to close at, and of course, not so bad year actually. Um, some pockets of the market certainly have done poorly, but given the fact that we were enjoying the rally for so long, some speed breakers are always expected. So we will today talk about viewer questions. First, of course, the first episode of the Momentum podcast goes live on 30th of March with Mr. Yasar, uh, and we will discuss his journey. Hopefully, you will be able to see a lot of insights from his journey, and implement them in yours if you like them. Do give us a lot of feedback on this format of podcast. The idea is that all viewers should be able to relate or learn from others' experiences and add to their investing journeys. So this one starts on 30th March, Sunday at 10 a.m. Today is the Ask Weekend Investing Day. On Fridays, we do the Ask Weekend Investing round. This is round number 39. And of course, first we have to read the disclaimer fully and agree that this is informational, not intended to serve as an advertisement or promotion. Do subscribe to the channel if you like the channel, and let's see where the markets are now. So Nifty 50 for the day down 0.31%. Um, in the last three sessions, when we had reached nearly 23,900, we have given up about 400 points net. But after a rally of this nature, 300-400 points is probably nothing. And what you will probably also notice is that we are at the very beginning of a right shoulder here. So if the markets do intend to go up above 23,800 or so, you will find that this inverted head and shoulders pattern will get triggered, and we may get a, if that is triggered with good volumes and it's a tight right shoulder, you may find that an unbelievable rally can start if that happens. Uh, till such point that we don't break yesterday's low, I think we are reasonably safe. So consolidation zone between 23,400 and 23,800 is likely going forward. I think the quarterly and year-end results will start to roll out from second week of April, and the RBI meet also near there. That should be the leading indicators for the market going forward. Nifty Junior down 0.63%, but hanging in there at the consolidation, no problem at 63,000. Mid cap index down 0.29%, small cap index absolutely flat. Absolutely flat. Bank Nifty also absolutely flat, 0.02% negative. Gold is up 0.32%. It touched a new high near 90,000 today, is currently trading at 89,400. In dollar terms, gold is at 3071, which is a new all-time high. Many institutions are pegging the targets for 2025 at 3,200 to $3,400. If we have a long-term CAGR of 12 to 14% on gold, which has been the case for the last 5 years, you will reach 6,000 by the end of this decade. Market breadth down from yesterday. We are at 190 advances today versus to 327 advances yesterday. Declines were 310. We had 173 declines. So certainly a declining day versus yesterday, but much above the long-term average. IT stocks hit the most, minus 3.6% on Wipro, 2% on Infosys, HCL Tech, nearly a percent on TCS. Shriram Finance was hit, M&M, Maruti, Bajaj Auto hit in the auto space, Cipla and Dr. Reddy hit in the pharma space. Tata Consumer was up, uh, and you had ICICI Bank go up. Kotak Bank was up. Kotak has been doing well, and you had some sporadic small gains in Bajaj, Finserv, HDFC Life, etc. No major shakes, no great shakes happening in the Nifty space. In fact, the Nifty Next 50 space had much more red. You had Lodha come off 3.6%, ICICI Pruli at 4.5%, LTIM, Divi's Lab, Zomato, VETL, Adani Power, Tata Power, JSW Energy. So energy, a lot of energy stocks coming off. Again, no real gainers from this space as well. Sectoral trends, capital market segment, which is not reflected in the top large caps, moved up 3.2%. So what has happened here is that SEBI has come out with a consultation paper, and they are saying to the exchanges, I mean, you either have the benchmark index expiry on Tuesday or Thursday, but don't make this nonsense of everyday expiries and frequently changing expiries, because NSE had recently put in an application to move its weekly expiry to Monday. Everybody wants to capture the business on a day which is different from the other exchange. So if BSE is Friday and NSE is Monday, they are capturing, volumes on both days. Whereas if both are on, let's say, Thursday, then the volumes will get divided to some extent. And BSC uh, probably is the winner between the two on a very short term basis. And BSC stock went up like 16% today. NSC stock is not listed. I don't know how much it fell uh, in the off market. It's an unlisted stock, but uh, certainly this round of move has gone towards BSC. There is also news from SEBI that NSC IPO may not come for the next 2 years. They have, I think, given some roadmap what all they need to do before the IPO. So NSC IPO issues don't seem to be going away. Nevertheless, NSC is a fantastic uh, unlisted stock. If you get it cheap, one can possibly always buy it. IT stocks, as I mentioned, losing 1.8%, real estate 1.4%, autos, this entire tariff business 25% executive order has been signed for all automobiles which are non-US based manufacturing coming into the US. So I'm not sure how many um, cars are going from here to the US, probably none. And if the reciprocal tariffs are forced by the US on India, that you cannot have 100% duties on cars coming in, that will impact the local manufacturers more. Let's see where that goes. Metals also down 0.7, pharma, tourism, all of these sectors were down. uh, More or less a bias towards negative day today. Only capital market standing out due to that one specific news. BSC, as you can say, so it was not 16%, it was 17.5%, running up dramatically. Capital market index itself has rallied pretty hard from its recent lows. CDSL, Computer CAMS, MCX, Anand Rathi, Nuvama, all doing well today on this space. Let's go into the Ask Weekend Investing round 39. We've done 38 rounds and 689 queries answered before this. They are linked in the description. You can watch them. You can learn about momentum investing, about small case, about weekend investing, and in general about everything about the markets. The idea here is to try and share whatever information, market knowledge that we can through this medium. So the first question, 690 question, is to team Weekend Investing. I truly appreciate your effort in putting out such valuable insights on a daily basis. From a technical standpoint, when would it be safe to assume we have actually bottomed the present correction? So tops and bottoms are usually called out once you are far away from them. Otherwise, it is just like throwing darts that you may be right or you may be wrong. Once you have, on a, let's say, on a weekly basis, weekly chart, you have made some bottom and then you bounce from there, and then let's say you don't go back to the same bottom or below that, and then you bounce and make a new high, so you will have a higher high and potentially a higher low, or even if it is the same low, it's a double bottom in that case. That is probably where you can say that there is a very good chance that the bottom is in. Even that is not 100%, because you could still have a higher high and then the technical setup could collapse. So all these are hindsight nomenclatures. Okay, so, September was the top. When we were in September, nobody could call the top. Yes, you can keep guessing it every day, and someday somebody will be right. So from that point of view, there are people who will call it right each year, but for them to consistently call it is next to impossible. So somebody who called the 2008 crisis, let's say Dr. Bari of the Great Short Sell. If you haven't seen that movie, you must see that movie. Uh, if he was right then, I don't know if he's ever been right again after that. Uh, so calling probabilities, forecasting, all this has very limited, I would say, effectiveness. Yes, you can be right sometimes, but it's very difficult to be right a lot of times. Shreyans says, how much of market performance is driven by fundamentals according to momentum practitioner? Does revenue growth, PAT, moat, etc., even matter in a broad scenario where liquidity drives? So ultimately, it is all about why liquidity is going into a particular country, sector, stock. There could be many reasons for that. So, for instance, um, India attracts a lot of capital also because we have a lot of numbers. We have a billion people who need to go up the value chain. Just because of that, there is money coming in. There could be specific reasons regarding some companies' growth, as you mentioned, revenue growth, PAT, moat, etc., where the perception becomes that yes, this company is the leader for the next, I don't know how many years. Liquidity goes towards that. So yes, I mean all this matters, but do you want to have that hook of PAT or percentage growth or moat as your decision point, or do you not care about that and just watch liquidity where it is going and where it is coming out? Let's say, for example, very recently I was talking about one footwear company which is down already 70%. At the top, it was being sold, by marquee investors, that this has such a big moat in the market that it can't go down, or it has a brilliant future. Maybe it does have a brilliant future, but it's already down 70%, and I believe the earnings is still like at 50 or 60 times. The earnings itself is dropping. So all that, according to me, and I am very sort of biased against forecasting. So for me, earnings and everything is like I don't want to base my buy or sell decision based on that. It is good that if some company has some great earnings and earnings growth, let the liquidity recognize that and move towards that. That is what I'm looking at. So it's more of a second order decision making than predicting that okay, this X company is going to grow this much and hence I want to buy that. I hope you can make out that subtle difference. Raksash says, first of all, big thank you for your valuable daily insights. I'm recently retired from PSU. My query is that you have any plan where a lump sum amount is invested and continuous withdrawal is possible like SWP. So, sir, we do not have any plan where, which is like a mutual fund plan of SWP. And also, the regulator does not want us to recommend anything. So, if you can go to our website and see our products and decide, that will be probably the best way. Uh, Ahmad Zishan says your trading view chart relating to gold price shows the formula. This. Is it simply conversion from USD INR and ounce to gram or something more? What more could you be asking for? I can tell you this is the gold price in dollar terms. We multiply it with USD INR, it becomes gold price in rupee terms. You multiply it with 1.06 because 6% is the customs duty that is there. Then you divide it by 31.109 because 1 ounce gold price is in per ounce, dollars per ounce. So you are dividing that by 31.109 to make it into per gram basis. And then because the purity of the gold price is based on 999 gold, which is 99.99% pure gold, whereas the market standard is point, uh, 99.5% gold. Hence, you will do a multiplication factor of 995 divided by 999 to make it into a market delivery purity basis gold price. So this formula should get you uh, the synthetic gold price basis what is the spot gold price in the in the market. And this gold price also needs to be spot price. So you on trading view you can see XAU USD can be replaced here. This is probably the futures price that you're looking at. Or and You're saying why don't you just divide it by 28.34? If this comes to this, then it's the same, right? I mean, but this is more descriptive as to why how we have achieved that price. I hope you got your answer. Deep says, I was waiting to invest near the recent bottom, but the bounce was so rapid that I missed the chance. Should I wait for the same level or simply invest now when the opportunity is right here? So never keep waiting. Please keep investing gradually. As markets will come off, there will not be one day where you'll be able to say, okay, now is that moment of that bottom. So because all strategies are long term in nature, you probably are going to bear the fruits of it over 3 5 7 year period. It won't make a difference whether you invested 3% lower or 3% higher. Believe me, it will not make a difference. But if you are doing lump sum investing, yes, it can make some difference. I am not in a favor of lump sum investing anytime. So gradually bring in your money, because you may be assuming that this is the bottom is done, but maybe there is more bottom to come. We can't say. Piyush says during last rally, some MI20 stocks have gone more than 100% up. But these we sold really late. With SIP nature, realized returns were less than 6%. Will we be able to recover losses with such profit booking? Should we relook strategy for during exceptional gains? So the strategy has been thoroughly tested over the last 10 15 years of data. The strategy has done well overall in terms of the returns. What we normally want is that we want the upside, but we don't want the downside, which in real life is not possible. So stocks that will go up exponentially, uh, the strategy will allow them more room to jiggle out at the top, and sometimes it will work, sometimes they will come off. So on a month to month basis, we cannot really have any strategy for that matter. Even Warren Buffett cannot beat the markets all the time. So have the right expectation. See over any 3 or 5 year period, is the strategy performing? If it is not performing, move on to something else. If it is performing, don't try to micro sort of expect that every week, every month, every cycle will be a performance beating cycle. No strategy can do that. Trend follower says, which time frame is best to capture long trends in stocks? So depends upon your strategy. It is like saying, what is the best speed to drive my car? Is it 60? Is it 70? Is it 80? It is 90? There is no one right answer, right? I mean, it all depends upon you as the driver. If you are happy with seeing deeper drawdowns, you can go to maybe monthly or yearly time frames where the decision making may be delayed, but the churn will be very low. If you are a person who don't want to see deep drawdowns but are okay with frequent churning of your portfolio, you could come down to maybe weekly or daily time frame. So it all depends upon the design of the strategy and your psychology towards the market. Shayan says, is now a smart time to enter momentum strategy, or does timing matter less when you're following momentum? Timing does not matter to me. If you are a 3 5 year 7 year kind of an investor, it will not matter where you enter, as long as you gradually bring in your money. I don't want anybody to sell their house and bring in the money at any one point of time. Arjun says, how to deal with confusion of choosing strategies between rotational and absolute, and on top of that, confusion of asset allocation. Sometimes 50/50 sounds perfect, sometimes 75/25. So the ideal way probably is you have both rotational and an absolute. If you are not comfortable with only one, uh, both have their own advantages, as most of the users would have seen by now. There is no right or wrong answer there. Um, Asset allocation is something which is basis your personal goals, risk profiling, which of course we cannot do on a one-on-one basis. The license doesn't allow, but your financial advisor should be able to tell you that how much equity, how much gold should be there. Normal thumb rules: 100 minus your age into equity is a very sound sort of a thumb rule. So if you are 40-year old, maybe 60% into equity is good. Age divided by 2 as percentage of your net worth into gold is also a decent thumb rule, I think, which is out there. Uh, Probably I created it, I don't know. That is also sound to me. But again, I mean, what is sound to me may not be sound to you, and certainly I cannot prescribe that due to the limitations. So somewhere around there is where you'll have to sort of figure it out. Student at market says, when both FIDIs are buying, who sells such huge quantities? So this is actually rare, uh, and we are assuming in this statement that when FIs are buying, then if there are 2000 FIs registered, they are all buying. So when the FI figure is, let's say, plus 1000 crores, there could be half the FIs who have been selling and half the FIs who have been buying. Net figure is FI buying, and that could have been partly from the market and partly from some institutional investors. Could be a promoter selling, could be some family offices also. So but usually you will see that institutional buying and selling is crossed with institutional buying and selling on the other side. Unless the stocks that they're selecting are extremely deep, none of the institutions actually buy from the marketplace because the depth is an issue for them. And hence you will normally find that the net buy of FII and the net sell of DII, or the reverse, are sort of counterbalances, because those kind of quantities are not available anywhere else. I hope that answers. So this is the end of the Ask Weekend Investing round. Please use the hashtag in the comment section, and we'll take it up in the next episode in case we've not been able to take it up this week. All the previous episodes are here in the description if you wish to go through them. Do watch the podcast on Sunday. Thank you so much for watching, and do subscribe to the channel. Thank you. Bye bye.